Joe, I'd love to start with you. I mean, that's a pretty consistent theme, obviously, from Fed officials saying inflation is job one. The economy's strong enough for them to go relatively fast. What does it mean as an investor right now? I mean, we've already priced in a fair bit of financial conditions tightening and valuations are down a bit. But is there more to go?
Hi, Mike. It's good to be with you this afternoon. I think there is more to go. I think the tightening of financial conditions is going to continue. The Fed has a real challenge on their hands with inflation. I think it all starts with inflation. And today was a good example of sort of good news is bad news in a sense, because we had a reasonably good unemployment report, yet the markets viewed that as, well, this means the Fed's going to be that much more aggressive. And there you run the risk that there's a policy mistake if the Fed pushes too hard to try to bring down inflation. So bottom line, we expect volatility to continue as you work through this change in the policy mix that we've had.
Volatility you expect to continue, Joe, but I guess directionally, do you have a way you would lean in terms of stocks, or what looks like have been some opportunities that have been surfaced by a lot of the chop we've seen already?
Yeah. So I think a lot of the damage has been done. That said, given that we expect a slowdown in economic conditions, we would remain defensive. You know, we went in our asset allocation committee earlier this year to underweight equities. We hadn't been underweight equities in a long time. So, you know, that's a reflection of what we thought we were going to continue to see. And we've reduced the beta exposure in portfolios where we have that flexibility. So moving up in quality, lowering beta, remaining a bit defensive, because we're not through this, as Jamie Dimon, I guess, coined the term, we're not through this storm yet.
Yeah. In fact, if you listen to him, the storm hasn't even struck yet. We'll see how that plays out. Charlie, obviously, you've been on Inflation Watch since before it was the thing to do. You're still on it. Now, there's this line now a lot of people are embracing, saying we've hit peak inflation. Now it's just about, the exact slope of decline. What do you think about that? And what does it mean for the kind of stocks you want to own?
Thanks for asking, Mike. And by the way, have you picked your Maverick call sign yet? I think you should be Mike Chart Santoli. Anyway, thank you for asking this. People are way too focused on whether we've hit peak inflation or not. That's not the right question. If we're at 8.3 on CPI, if it goes to 8.2 and then 8.1, that doesn't matter. It's the absolute level of inflation that matters. As I tell people, if inflation is 7% this year and 8% next year, it is exactly the same from a purchasing power point of view as if it's 8% this year and 7% next year. Inflation is commutative. As we all learned in fifth grade, it doesn't matter the order that it incurs. So the short answer is that we are not going to be getting down to acceptable levels yet. The Fed is not acting nearly quickly enough or hard enough after all of these years of quantitative easing and buying $120 billion a month. They're only now selling $45 billion. They've got an $8.9 trillion balance sheet, and they're selling $45 billion a month. That's way too little. We have a Fed funds rate that's still 75 basis points to 1%. That's way too low. This Fed is still not acting strongly enough.